Welcome to Miss TEIIS, Making Learning Easy. Today's topic is cash flow forecasts. As part of our Making Learning Easy series, we're going to take a quick look at the key things you need to understand about cash flow forecasts to answer any questions that may come up. In this presentation, we're going to look at how you construct a cash flow forecast, how you calculate total inflows, total outflows, net cash flow, and the closing balance. We'll also take a look at causes of cash flow problems. Okay, so what do we mean by cash flow? What is cash flow? In its very simplest terms, I often say to students, it is what the name suggests, cash flow, the flow of money into and out of a business over a period of time. So what is a cash flow forecast? A cash flow forecast is a prediction of the flow of cash into and out of a business over a given period of time. And the key word here is it is a prediction. What examples of cash inflows are customer payments, loans, grants, and any capital investment. Example of cash outflows would be staff wages, utilities, gas, electricity bills, any production costs, property rental, insurance, etc. Key terms that it's important to understand for cash flow forecast. Cash inflows. This refers to money coming into a business mainly from sales or provision of services. Other sources of income may be included, property, rent, bank loan or a grant. Cash outflows. This refers to money going out of business for items of expenditure such as rent, wages and bills. Then the net cash flow, which is the difference between cash inflows and cash outflows. Another key term you're going to come across is the opening balance. That's the amount of money in a business at the start of the month. And the closing balance, again, it's as the name suggests, is the money left in the bank at the end of every month. So you've got cash inflows, cash outflows, net cash flow, opening balance and closing balance. If you understand these key terms, you can begin to access questions on cash flow forecast. Okay, so here we have now the structure of a cash flow forecast. We can see the months. It starts off with the different months. So you've got July, August, September, October, November, December. So it's a 6-month cash flow forecast. You've got your cash inflows. So this is your income, the money you've got coming in to the business. And then you've got your cash outflows, which is sometimes known as your expenditure, the money you're spending. And then you've got this thing we're calling net cash flow. So the formula for net cash flow, if you follow the arrows down here, net cash flow is equal to the cash inflows minus the cash outflows. Really important that you know your net cash flow at the end of the month. Okay, then you've got this thing called your opening balance, and your opening balance is the closing balance of the previous month. At the very first month, it's the amount of money you start the business with, or you start at the beginning of the cash flow forecast. The closing balance is the net cash flow plus the opening balance. So if you think of July, in July, you've brought into the business £12,000. You have in fact spent £15,000. So your net cash flow is a minus £3,000. But you started the month with £5,000 in the bank, so your closing balance is £2,000. So it's really simple. All you have to be able to do to calculate your cash flow forecast is add up and subtract. So what is a cash flow problem? A cash flow problem occurs when cash outflows are greater than cash inflows. Let's take a look at an example. Cakes galore. Here is the cash flow forecast for April 2020. The company is predicting cash inflows of £68,000. That's money coming in from perhaps sales of cakes and other items that they sell in the shop. They're predicting cash outflows of £96,000. That's money they're paying to their suppliers and wages, of course. So the net cash flow, which is the difference between the cash inflows and the cash outflows, is minus £28,000. So at the end of the month of April, their net cash flow is minus £28,000. But what did they start the month of April with in the bank? In the bank, they had £10,000 already. So the closing balance for the month of April would be the opening balance plus the net cash flow. So that's minus 28,000 plus 10,000, which gives you a closing balance of minus £18,000. What that tells us is that Kate's Galore do not have enough cash to pay their bills. They have a negative closing balance in April. What that means in practical terms is, for example, in the month of April, if they do not make overdraft arrangements, they would not be able to pay their suppliers or perhaps their workers. So let me give you an example. If you're a student and you're working for Kate's Galore, you complete all your work for April and then you go to get paid and Kate's Galore can't pay your salary, that might start to impact on your willingness to go to work if it happened consistently. So it's not just a one-off, it happened consistently. You're beginning to see how that would give a company solvency issues. So if the company cannot pay its bills consistently, it would lead eventually to that company going into liquidation. Thanks for watching this video. Cashflow forecasts from Miss TEIIS as part of our Making Learning Easy series. If you want to find us, you can follow me at TEIIS London, or you can visit my website at www.faec.agency. I'm also on TES as Miss TEIIS. Don't forget to subscribe and thank you for watching.